This test review does not include master budgeting. However, I have separate videos on that. So if you are interested, click on the links below this video to watch tutorials on the master budgeting. Since we are having remote classes, you may be required to take a test, and using an Excel, you can still write in your Excel like you do on paper. You just have to get rid of these grid lines. So this is how you do it. You go to page layout and you see the grid lines and you uncheck this box and it gets rid of the grid lines. Or you can select, you bring them back and then you get rid of them. Okay, good. So this is what I'm going to do. I'm going to take advantage of this technology to write on this as I would do on papers, on a paper. Okay. What I have here, so I'll begin with chapter 9. Okay, chapter 9, if you recall, you learn about actual budget. Okay, we use B as budget, flexible budget. B, and then what we call planning budget. B. Great. These three budgets have meanings. Okay, when you talk about actual budget, this is what actually happened. Okay, what actually happened. And what happened, you'll be given revenue. You will know your revenue and your expenses. That is what happened. They will tell you, okay, this is what have happened. This is how much we made, and this is how much we spent. That is your actual budget. Flexible budget is what happens based on, this is based on actual unit. Notice what is that? Based on the actual unit. So the actual unit from here. Okay, good. And we have planning budget. What we plan. So let me see what we plan. And when you plan something, you are acting. Okay, so see this planning as an act. So you are acting when you are planning something. And this is very essential when it comes to knowing the differences between these two. Okay. You may be asked to find activity variance. Once you hear activity variance, you know, oh, planning is an act. So that means it has to do with planning. Okay. If it has to do with planning, then it cannot go all the way to be compared with this. It has to be compared with this one. Okay. So that is what we do when it comes to activity variance. You compare the planning budget with flexible budget. So activity variance will be here in between. Because the names tells you what it is, because we have planning is an act. So planning versus flexible budget. Now, you also be asked to find revenue variance, revenue and spending variance, okay? So revenue, no, actual, we have been given our revenue and spending. Expenses are spending, okay, how much we spent. So that makes it fall in between actual and flexible. So revenue and spending variance falls between these two. Good. So once you hear that revenue variance, you know, okay, has something to do with actual, and actual can only go with flexible. So those two things I'm going to compare. Activity variance, oh, it's an act. Okay, so what did I act? I plan. Okay, so it has something to do with planning, and then it's planning can only go with flexible. Let's go ahead and solve some exercises. So if you are taking a test and it's an open book, hallelujah, good luck for you. So what you just need to do is set up your format, and then you just put in the essential information. Okay, so that's what I did here. I already have my formatting set up already. So I'm just gonna follow it and do it. Okay, so we have this company here that wants us to do planning budget for December. Let me use a different color. Okay, planning budget for August. Okay, so I have this set up. So how many budgeted cars? So this is a car wash car. So everything here is what the company plan to do. Okay. So now, how many cars did the company plan to wash? So they plan to wash 9,000 cars. So that is the quantity, okay? So the quantity, that is 9,000 cars. So I'll put my 9,000 cars over there. And then what is my revenue, okay? How do I find my revenue? 9,000 cars multiplied by 4.9, because every car they wash, they charge $4.9. So that is what I'm going to do, 4.9 multiplied by the number of cars washed. That gives me 44,100. Good. And then we have expenses. Okay. So the expenses are listed here. Everything here is expenses. And remember, the expenses had fixed costs plus variable costs. And the cost driver for this variable cost is the number of cars washed. Okay, so let's go ahead and start with cleaning expense. Cleaning expense does not have any fixed, but it has a variable cost. Okay, so what we're going to do is we multiply 0.8 by number of cars washed, because every car they wash, the cost is $0.8. Okay, so that gives us 7,200. And we have electricity. Electricity has fixed and variable, so we put in here 1,200. 1,200 is our fixed plus what is the variable? The variable is 0.15. Okay, 0.15 multiplied by the number of cars washed. So we close parentheses and then we have 2,550 over there. Maintenance. Okay. So we're done with electricity. Now let's go on to maintenance. The maintenance doesn't have any fixed cost, that's good, but it has variable cost. So we have 0.2 multiplied by the number of cars washed. That is our maintenance. Now we have wages and expenses, wages and salaries. It has fixed plus variable. And how much is our fixed? $5,000 plus what is our variable? Variable is 0.3 multiplied by the number of cars washed. Okay, so we have that one there, 7,700. And then this one is taken care of. We have depreciation. It only has fixed expense, so we put in 6,000 there. And then you notice that rent also only has fixed expense, so 8,000 there. And then we have administration has fixed plus variable, so that is 4,000 plus what is our variable, 0.1 multiplied by the cost driver, which is the number of cars washed. We close parentheses and we have 1,4,900 there. Now we're going to sum up all the expenses together. So all these expenses, we sum them up together. We have 38,150 expense. And then our net operating income will be our revenue minus our total expense. That is our net operating income. Good. Now we are going to do the next one, which is we have been asked to find our flexible budget. Okay. Remember, if we go back, if we recall, flexible budget is based on actual units. Okay. We are going to do everything based on actual unit. What is our actual unit? This is our actual unit right here. That's 8,800. Okay. So notice what I'm going to do. It will change. It will just solve everything on its own. So I'm going to copy and paste. So I copy and paste this here. So if I have this on the test, very easy. The only thing I need to do is to change the name of the budget. Okay, so the name of the budget, this we're doing flexible budget. So I'm going to type in flexible budget. Okay. Now the number of unit is 8,800. Okay. So I'm just going to type in 8,800. And then you notice it changed everything. Okay. So the net operating income for number 2 is this. Net operating income was different. That's our flexible budget. Okay. Now let's move on to the next one. We have been asked to find activity variance. Okay, remember, if I take you back, activity variance is planning. Okay, so activity, that means we're going to compare planning versus flexible. Okay, good. And because I have this one already here, I'm going to copy and paste. So let me take my planning. So this is my planning. Okay, I'm copying and paste right here. Okay, and I need the flexible next to it, okay, to compare it. Okay, so this is my flexible. Okay, flexible next to it. I'll copy that one from budgeted costs. Okay, so that's my flexible next to it. I'm going to compare them together. Okay, let me make sure this one is uniform. Okay, everything here is uniform now. Okay, so I'm going to type in here to just indicate this is planning and this is flexible. But remember, the title of the activity, the budget says activity variance. Okay, so activity variance. Okay, good. So we have the two. We are going to compare these two together to see which one is favorable and which one is unfavorable. Okay. Okay, I like fancy stuff. Okay, now let's do this. Remember, you are not going to compare the unit. Okay, when it comes to comparing this, you are not going to compare the unit. So you are going to ignore this unit over here. Okay, this is not what we are going to compare. We're going to compare the revenue and the expenses. Okay, good. So what are we going to do in terms of this? So this portion will be the activity variance. We're going to compare the differences between those two. Okay, so we plan to have this revenue match, and but the flexible test as this. Okay, so this what is happening. You have planned to do this, and then you are presented with flexible. Okay, your revenue is higher, so you are like, no, what you are presenting to me is not favorable to me. I like my own. I like what I've planned. I will stick with what I'm planning because that gives me more revenue. Okay, so that means that what you have been presented with flexible is unfavorable. Okay, because that one will give you less revenue. That's unfavorable. Now let's compare that one to with what do we call it? Expenses. Okay, so this minus that. Okay, so we plan to spend. So expense is opposite of revenue. We plan to spend this amount, 7,200, but according to the flexible, we would spend this amount. Okay, so what we have planned is not favorable. So the flexible is favorable, so we will accept the flexible. So that makes it favorable. Okay, so we are comparing. Remember, we are comparing with the flexible. Okay, you have your planning. You have planned to spend 7,200, and the plan is presented to you that okay, you have to go with flexible. You only spend 70/40. So is what being presented to you favorable or not? Yes, it is favorable. Okay. So I'm going to drag this one down, and that gives me the difference of 30. That is favorable because we plan more and then we spend less. So that is favorable. Okay, so let's go on to the next one. Let's just actually do everything. Okay, let's compare. Okay, now this one, we spend less, more. Okay, so this one becomes favorable. Okay, and this one too, we spend more, so that one becomes favorable. We plan more. This one is irrelevant. These two, they are irrelevant. They don't matter. So you just ignore them. Okay. And these two also, we were going to spend higher, but this is less, so that's favorable. And here we were going to spend higher, and we're going to end up spending less, so this is favorable. But the net operating income, okay, we thought we will have a net operating income of this, but this is higher than this one. And what we are presented, if we go with this one, we will have less net operating income. So that makes everything for net operating income unfavorable. Although the expenses are favorable, they are not that much to, what do we call, to balance the revenue that we are losing, okay? Good, so that is your activity variance when you are asked to do activity variance, that's how you do. In case you were asked to do spending variance too, you do the difference between what you have actually been given and then versus the flexible. For time's sake, we will move on to chapter 10. Okay. Now, we have chapter 10. So chapter 10 too has similar concepts, okay, with actual, flexible, and planning. Okay, and what we need to do is I'm just going to explain some concept to you. Okay, and then we'll move on and solve some exercise. And this one too, because I want to write in, I will get rid of the grid lines. Okay, so I can write. Okay, so with this one, you have, okay, let me start my pen drawing. Okay, we will still stick with actual. So there is an actual. Okay, there is flexible in between. And there is standard. Okay, good. We have standard, we have flexible is always in between. It really, we're not going to need it that much, but when looking at the formulas for this one, you should be familiar with these formulas. AQ multiplied by AP. Okay, and here will be SQ multiplied by SP because everything is S standard. and S standard. This is A, and this is also A. But with flexible, it doesn't have any formula. So it's going to take one formula from this one here, and it's going to take the price from this one here. So flexible will end up being AQ multiplied by SP. Okay, good. So let's pay attention. Let's focus our attention on flexible and actual and standard. Okay, so the formula for actual and standard. Okay. Now you will be asked to find price variance and quantity variance. Okay. You may be asked to find that. So we have this one, the difference between these two, the difference between these two. Okay. But to make it very simple for you, let's focus on actual and standard. Okay, I'm going to focus on actual and standard. Let's check their formulas. Okay, so we have actual here. This is the formula for actual. That is AQ multiplied by AP. Okay, and then our standard, use a different color. So standard SQ multiplied by SP as a standard. Now, when you hear price variance, they will ask you price variance, okay? Once you hear price variance, price, okay, P, then you know you are going to find the difference in price, okay? Differences in price, okay? So you take, okay, this is P, okay, this is AP, and this is SP. So that means I'm finding the difference between these two. So that's AP minus SP, okay? And because we have AQ here, okay, I'm gonna put the AQ outside. That's price variance, the quantity, the number of units I bought, okay? Good. And when you find, or when you are asked to find quantity variance, okay? So let's use a different color, quantity variance. You are going to find the difference between the quantity. Okay, that's the difference between the quantity. So we are going to use this AQ and SQ. That's the quantity. Okay, so the formula will be AQ minus SQ. Okay, and then we put the SP outside. That's the price, SP. Okay, so that's the formula you need to remember. Okay, in case you were asking and you want to do it to see how this one will look like, this is what it will look like because we are finding price variance. For instance, price variance. So we need to take this what too. So we take AP minus SP outside, and then because this is the same AQ and AQ is the same, so we put it outside. That's the formula we did here. Okay, and now quantity variance. We know we are dealing with Q, so we take our AQ minus SQ. So AQ minus SQ, okay? And this is SP is the same as this one, so we put it outside. So remember this, okay? This is a very essential, okay? When you are looking for price variance, is the difference between the P's. When looking for quantity variance, is the difference between the Q's, okay? But you put one outside of the box. That's the, you put AQ outside the parentheses. Now, when it comes to price variance, what it means, everything that it means that we're asking you is, okay, materials that we purchased, okay, the materials we purchased, okay, these materials we purchased, is it good compared to standard? Okay, so materials here will be materials purchased, okay, and when it comes to quantity variance, materials used. So the materials used, you need to pay attention to that. materials we used. Okay, so as you going through all over the formula, you need to remember that. So now let's move on, because I want to get rid of my grid lines so I can write and look pretty. Okay, so I'm gonna get rid of those grid lines and then see if I can solve this problem. To be bad if I couldn't solve it. Okay, hopefully. So let's see what we can do here. Okay, number one, we have been asked to, I don't know why I don't select my red pens. Okay, to find price and quantity variance. Okay, I know once I hear my price variance, I know I'm finding the difference between the P. So I would do AP minus SP outside, and then AQ comes outside. Okay, now what is my AQ? Number of units, okay, units that I purchased. Remember, AQ is materials purchased. Okay, so I'm going to look for my materials purchased. I purchased 25,000 microns. Okay, so once you have given the problem, you will be told where everything is. So this is the following said, the following in standard. So everything here is standard. Okay, and here is actual. Okay, so it's different. This is actual and this is standard. So you know where to find your S, you know where to find your A. Okay, so now actual quantity, that's 25,000. So I have my 25,000, okay, into bracket. What is my actual price? How much did I buy? So I bought everything, actual price, that's per unit. Okay, so 0.48. Okay, minus SP, what is my standard price? The standard price is 0.50 right here. So because I'm looking for S, I went to the S column, 0.50. What's the difference? This one is 0.02 multiplied by 25,000. That gives us 500. Okay, now is it favorable or unfavorable? Okay, this is how you will know. Assume that this is X and this is Y. You want Y to be bigger. So if Y is bigger, it's favorable. If Y is smaller, it's unfavorable. So here, Y is bigger, so this one becomes 500 favorable. And now this is how you can compare it as well. Okay, your price, actual price, you paid for this. Okay, and the standard says you should have paid for this. So you know the standard is too much, it's higher. Okay, so that means it's favorable for you. You will stick with your plan. So what we paid actually is favorable. It's better than the standard. Okay, good. So that is our price variance. Now let's go on to our quantity variance. How do we find our quantity variance? Let me move this one over here. Okay, find our quantity variance. Let me use this pen to do say quantity variance. So I know I'm dealing with AQ minus SQ into bracket. Okay, and I put SP outside because I need to find the price. Okay, because in the parentheses are Q and Q, I need to put P outside. Okay, here the parentheses are P and P, so you need to put Q outside. Okay. Okay, so yes, now let's do this. So what is my standard price? My standard price, I'm going to look at here. So the year is standard and everything here is actual. So my standard price, 0.5, didn't change, so 0.50, okay. My actual quantity, okay, this is where we have the number of unit materials used, okay. So how much materials did we use? This is where we have to do our reading. So it says, okay, we bought this 25,000, but 5,000 is still available in the inventory. That means we only use 20,000. Okay, so we put 20,000 here. Okay, minus what is our standard quantity? Okay, what is our standard quantity? Standard quantity we're going to look at here, and it says we use 6 microns per toy. Okay, so that means to find our standard quantity, we need to multiply 6 by the number of toys, and the number of toys are 3,000. Okay, so 6, 3, 18. So that gives us 18,000. So that means our standard quantity is 18,000. Now, from just looking at it, is it favorable or unfavorable? It is unfavorable because Y is lower. Okay, so that becomes unfavorable. Even before I find the number, I know it's unfavorable. So 20 minus 18 is going to give us 2,000. So 2,000 multiplied by half is 1,000. Okay, 1,000 unfavorable. So that is our answer for quantity variance. Okay, good. Let's move on to answer the second one. Question 2. Which says we need to find labor variance and efficiency variance. Good. So this is similar to quantity variance and price variance. Okay. So if I will go back and do some computation for you, we have actual. Okay, actual. You remember in the previous one we have AQ, but this one is hours. Labor days with hours. Okay. So we're going to have the formula as AH multiplied by AR, that is rate. Instead of price, this one, instead of price, it becomes rate. Okay, and then the actual hours, this one is hours. So so therefore the standard will be, we have the standard as SH multiplied by multiplied by SR. Okay, multiplied by SR. So that's our formula. So let's move on to find our, what do we call it? Our labor variance. Okay, labor rate and efficiency variance. When we talk about labor rate, okay, labor rate variance, that is the rate variance. Okay, so how much are we spending? Did we spend in making the product? Okay, so rate variance, we know we are dealing with the R. No, we are going to have the difference between the R. So AR minus SR, okay, into brackets. And then we put AH outside, similar to the formula above. Once you remember one formula, the following one should be easy. Okay, so I'm gonna move this up here. Okay, now, what is our AR? Okay, or what is our AH? Okay, what is labor? And that's our actual labor. Okay, so here is actual, here is standard. So actual labor, I'm going to look for the labor right here. Okay, so actual hours were 4,000 hours. So I'm going to put 4,000 hours. Okay, multiply by actual rate. Okay. So the actual rate seems that 4,000 hours, but we are going to pay 36,000. Okay, so we are going to take 36,000 divided by 4,000. Okay, so I will do that, 36,000 divided by 4,000. Okay, that gives us $9. So our actual rate is $9. That's what we actually pay, minus standard rate. Standard rate gives us here that $8 per hour. So we didn't need to compute that. So we have $8 per hour. Okay, now Y is lesser. So that means I know it's unfavorable. Okay, so 9 minus 1 is 1, and then 4,000. Okay, that gives us $4,000 unfavorable. Okay. Now, efficiency variance. Efficiency variance is the part that as how efficient were you in using your hours to make the product. Okay. And we know the formula. We are finding the difference between H. Efficiency is the hours. So how efficient were we in using our hours? So that will be AH minus SH. That's the difference. Okay, and then we put SR outside. So what is our standard rate? Standard rate is going to stay the same as $8, so we have $8. Okay, now, what is our actual hours? Okay, our actual hours is 4,000. Okay, 4,000 hours spent. Okay, minus what is our standard hours? So we go and look it for here. Okay, our standard hours says with labor, we spend 1.4 hours per toy, just like we did with the microns. So 1.3 hours per toy. and we made 3,000 toys. So we're going to multiply 3,000 by 1.3 by 1.3, and that is 3,900. Okay, so we have our 3,900 here. Now, is it favorable or unfavorable? It is unfavorable because y is lesser. So 4,000 minus 3,900, that is 100. 1,000, okay, multiplied by 8, and that gives us 8. Okay, actually 100 multiplied by 8, that gives us 800, unfavorable. Okay, good. So that's how you know x and y. If y is lesser, then it's unfavorable. If we want y to be bigger, if y is higher, then that is favorable. So this one is unfavorable. Good. So that it is for chapter 8, the variances. So we will move on to, should I solve this? Okay, this is, let's try this one as well. Or you can pause the video and try it yourself. But I'm going to be quick with doing this. I'm not going to talk that much. So I'm going to get rid of the grid lines, okay, to see how I want to solve this. Okay, so with the first one, which is price variance, I know I'm dealing with P. So AP minus SP. And then AQ outside. Okay, so 20,000 pounds. Okay, and AP will be 2.35 minus 2.50. So I know this is favorable. Okay, so I multiply these two together and I have 300 favorable, 3,000 favorable actually. Okay. Now, for the sake of time, that's why I'm hurrying, but your 2.3, that is your actual price, is right here. Okay, you have your actual price here, and you have your standard price, 2.50. Your standard price is right here. So you just put in the information that you have, and then you multiply that by the actual quantity. Okay. Now, for the sake of time, try this one yourself, so I'll move on to the next one. Okay. So I'm going to still get rid of the grid lines again, but this one with chapter 11, okay, there's formulas that you need to be familiar with. Okay, you need to be familiar with these formulas. So with chapter 11, you have, let me see, you have your ROI, that is return on investment. Okay, so return on investment is equals to margin times turnover. Okay, now these formulas also have meanings, or they have sub-formulas. Okay, so margin is net operating income divided by average operating asset. Okay, and turnover is sales divided by, actually not. So this one, net operating income, should be net operating income divided by sales. And this one is divided by average operating asset. Okay, so now with everything that is there, everything here, you can rewrite it again by ROI equal to net operating income divided by average operating asset. And this is how we find it, because you can, if you want to multiply these together, okay, this will cancel that, and you will have net operating income and average operating asset left. So that is how I end up with that one. Okay. Okay, so let's go on and see if we can solve. We can do some exercises in chapter 11. So I have 11, 12 right here. Okay. So we have been asked to find return on investment, ROI, in terms of margin and turnover. Okay, so we are going to use the formula right here in terms of margin and turnover. So that means we need to find margin and we need to find turnover and multiply them together. Okay. Yeah. So we have three companies or three sections. What do we call it? Three divisions, segments. Okay. So we have the first one, we are going to find our margin, and so these are ROI, but what is our margin? Okay, margin is net operating income. So net operating income is right here, okay? 600,000 divided by sales, and sales is 12 million. Okay, multiplied by turnover, and turnover is sales. The sales is 12 million divided by average operating asset, which is this one, 3 million. So what I would do is I will cancel these and I will divide 600,000 by 3 million. And that gives us our answer, which is equal to 5. That will give us 5. So that's how you find it. Okay. So you this one will cancel that, and we have 6 million divided by 3 million. Okay. So this one will give us, and let's see what we have here. So they cancel each other. We will have net operating income, or they want you to find, what do we call it, separately. Okay, they want you to find margin, and so actually I misled you there. They want you to find the margin and what do we call it, the turnover, and multiply them together. Okay, so this is actually a longer way. So this one will be 5, because 600 divided by that will be 5, and this one will be 4. So this multiplied by that gives us 20%. Okay, so that's the first one there. Okay, so now let's see the section B. So section B will be the same thing. So just follow the formula right here to do it. Okay, so you find your margin, and this is your margin right here, and this is your turnover, and then you multiply them together when you the answer that you have. Okay, so this will be easy. So I'm gonna let you do that one by just following the formulas. This one, the second one, is also pretty straightforward. You need to remember the formula for that. Okay, so you notice that you have been asked to find residual income for each division. So residual income, how do we find residual income? So residual income equal to net operating income minus average operating asset multiplied by minimum required rate of return. And you will learn this more rate of return in chapter 13, okay, on investment. Okay, so that is the formula. That's how we find the formula. Now let's go and do this exercise. We need to find the residual income. Okay, and the formula, I don't even need to list list anything into detail. I just put them there because this is a test. Okay, and I need to be fast. I need to find the answers quick. Okay, so equal to, what is my residual, what is my net operating income? So under A, my net operating income is 600,000. So I put 600,000 minus, I open the bracket, okay, because remember the formula. Let me rewrite it here. The formula is net operating income minus average operating asset multiplied by minimum required rate of return. Okay, so I have my net operating income minus, what is my average operating asset? Okay, under A, Average operating assets is 3 million. 3 million, okay, multiplied by minimum return investment, that is 14%, so 0.14, okay. So that is my A, okay, that is A for that. And then B, I'm going to do the same thing. My net operating income is 560,000 minus, okay, my average operating assets 7 million multiplied by the minimum is 10%. Okay, that's actually negative. Okay, and then we have here, what do we have here? We're going to do the same thing, net operating income, which is 800,000 minus average operating asset 5 million multiplied by 16%. And that one is 0. Okay, so that's what it is with how you do it to save time. Okay, you just put in the formulas in there. Okay, that's chapter 11. I was going to do this, but for time's sake, I want you to try it and let me know what you think. Okay, so chapter 6 also is likely, these ones also come to test frequently. Okay. Chapter 6 is what we deal with absorption costing and variable costing. Okay. So how are we going to do that? Okay. I'm going to get rid of my grid lines again and do some writings. Okay. So we have, you'll remember from previous chapters that you have manufacturing cost. So manufacturing cost. Okay. And to find your manufacturing cost, you need direct material, you need direct labor, and you need manufacturing overhead. Okay, that is your manufacturing cost. Okay. If you remember, manufacturing overhead has fixed and variable. Because how do you find your predetermined overhead? You need your fixed plus variable multiplied by, so you need your fixed plus variable multiplied by the cost driver divided by the cost driver. Okay, so this one variable here. So manufacturing overhead is actually fixed. It has fixed in and it has variable. So that's manufacturing overhead. But in this case here, we have absorption and we have what we call variable costing. So absorption costing, and we have variable costing. Think of absorption costing as absorbing, it's taking in everything. So absorption costing is going to take everything here, okay? It's not selective, absorption costing is not selective, okay? She will go on a date with any of them, okay? So, so here we have direct material, so it's taking direct material from our main thing. So direct material, it takes it, and it takes direct labor. So it takes direct labor too, and it takes both fixed and variable expense. So it takes fixed manufacturing overhead and variable manufacturing overhead. Okay, that is absorption. It's absorbing everything in. Now we come to variable costing. Okay, variable costing is picky. She's not gonna go on a date with just anyone. Okay, so this is what she's gonna do. I'm gonna take direct material. The name says it only takes variable cost when it comes to manufacturing overhead. So direct material, direct labor, and variable manufacturing overhead. So this one here leaves fixed manufacturing overhead hanging. It doesn't take fixed manufacturing overhead. Nope. Okay. So that is how we do it when it comes to, and we have income statement for these two. Okay. When it comes to finding the income statement for absorption and variable, so let me see, income statement. Okay. Absorption costing, because it absorbs in everything, has a traditional format. So absorption has the traditional format. And then the variable has the contribution format. Contribution. Okay. And just a reminder, you know, your traditional format is sales minus cost of goods sold. Okay, that gives you your gross margin. And then you have minus selling and administrative expenses. And that gives you a net operating income. Okay. Oops, everything just disappeared. Where was I? Chapter 6. Okay, yeah. So net operating income. But when it comes to contribution format, you have your sales and you have your variable expenses. Okay. And then that gives you a contribution margin. Okay, and then minus your fixed expenses. And then before you arrive at net operating income. Okay, so those are the two differences. Okay, so let's move on and see if we can do this exercise right here with chapter 6. Okay, so we have here, what do we have? As you can see, we have a company and says the following, blah, blah, blah. Okay, so the company has first year and also second year. Okay, I'm just looking for the most important things. Okay, and these are the cost. Okay, product and period cost. So this consists of product and period cost. And manufacturing cost is a product cost. It's not the period cost. Okay, so this is what we are going to do. It says compute unit product. Okay, I'm going to get rid of my grid lines. They annoy me. Okay. Again, so we are going to find our unit product. So let's begin with absorption. Okay, here it says pretending is variable. Okay, so I'm actually going to do with variable. So there's variable costing. Okay, and let's do it for just 1 year, because we have two years over there. Let's do it for just 1 year. Remember, variable takes in direct material, takes in direct labor, and only takes in variable manufacturing overhead. Okay, so let's see how we can do with that. So what is our direct material? It's going to take the 25. It's going to take the 15. But it's only going to take the variable manufacturing overhead right here. It's not going to take the fixed. Okay, so variable is $5. Okay, so our product cost is $45. Product cost per unit, $45. Okay, let's assume we are using what we call the absorption. So this is absorption. Okay, absorption will take direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. Okay, so that is what absorption will do. Okay, so what is our variable direct labor, direct material? That is 25. Our direct labor is 15. Variable manufacturing overhead is 5. Okay, now our fixed manufacturing overhead, we take this one. But remember, this one is for the total. Okay, and the total is, it says we produce 50,000 units. Don't multiply it with this. No, don't do it with sold. Sold is only used when you are doing income statement. That's how many you sold. But to find the unit product cost, you only need units produced. That's 50,000. So 250,000 divided by 50,000. And that is $5. So we have our fixed as $5. And I know it's only increasing by 5, so this will give me $50 as product cost per unit. That's cost per unit. That's $50. So absorption costing is different from variable costing. Absorption absorb everything in, including fixed manufacturing overhead, but variable is speaking. She doesn't want to go on a date with this anyone. Okay, good. Now, one more thing I want to mention before we close this session is predetermined overhead. Okay, predetermined overhead. So let me see, I'm going to get rid of the grid lines again. But remember your predetermined overhead, the formula especially. Remember how you should find it. So we have your predetermined overhead equal to your fixed plus your variable and cost driver. Okay, your allocation. Okay, divided by the same allocation. So the same allocation comes here. Or if you want to express this in a different, way, you can do A plus BX. Okay, this is more mathematical. Okay, because we use A, B, X and things. Okay, so the X comes here. Okay, that is your predetermined overhead. And remember, this H or X is from the previous year. That is why it's called predetermined. So previous year. Before the year begins, you estimated some amount for predetermined overhead. And whatever answer you have is multiplied by the actual to give you how much your predetermined overhead is. Let's do an example and let's see how that works. Okay. I'm going to get rid of this one again. So much fun. Okay. So what is our predetermined overhead when we want to find this? Because it says what is okay, predetermined overhead. Okay, and we know the formula is P equal to fixed plus variable H divided by H. Okay, now what is our fixed? Remember, this is from the previous year, and this is what it says overhead based on at the beginning of the year. Okay, so this, and they use these numbers to predict. We are predicting at the beginning of the year. Okay, this is the prediction. So what is our fixed manufacturing overhead? That is 650,000. Okay, 650,000 plus what? Plus our variable. Okay, what is our variable? $3. So 3 multiplied by what is our hours? 100,000. Okay, divided by the same hours. Remember, comes down. So the same 100,000. I don't know who came out with these numbers. I learned it and I'm just doing it. So now, what will that end us? Okay, so that will give us, the top one will give us 950,000 divided by 100,000. And that gives us $9.5. Okay, so that means we predicted at the beginning of the year. So anything we have here, every hours we spend has to be multiplied by this to give us our actual manufacturing overhead. That is what it is. You predict here, and then you multiply it with the actual. So you have here your prediction, and you have your actual. So once you get your prediction, you multiply it with the actual. Okay, good. Let's see if we can find our actual. So now, that is your predetermined overhead. Your cost will be $9.5 per actual hours. Okay, now let's go ahead and do the second one, which is the job costing. Okay, job 400 is done. Okay, and remember, this has nothing to do with variable and absorption. This is actually absorption. It's absorbing everything. This is not specific, so you are not going to concentrate on finding variable. This is just a general thing. Okay, so the general is absorption. So this is what we're going to do, our product cost, so manufacturing cost. Okay, we have our direct material, that is right here, $450. $450. Okay, and we have our direct labor right here, $210. And we have our manufacturing overhead, 40. Is it just 40? Aha, no. But 40 multiplied by 9.50. Okay, and that gives us $380. Is equal to 380. So if we add all of them together, we have 1040. So that is our predetermined overhead. You need to remember that. Okay. Remember predetermined overhead and how to do it with job cost. When it comes to job costing, basically what it is asking you is how much does it cost us to make the product? And it costs our direct material of this, direct labor, and then manufacturing overhead based on what we predicted that we're going to spend. Okay, good. If you have a question or if you have a concern, please let me know in the comment section, and I will respond to you with the problem and see how I can help you. But for now, there are so many ways of doing accounting, and whatever ways you find it effective, keep practicing, and good luck on your test.